conference over to Mr. Srivastav. Thank you, and over to you.
Thank you. Good morning, ladies and gentlemen. Hope you are all doing well and staying safe. We take immense pleasure in welcoming you all to discuss the operating and financial performance of the second quarter and half year FY21. I also take this opportunity to wish you all a very happy and prosperous Diwali. With the onset of the festive season, we are witnessing some very positive consumption trends at our malls as governments have gradually permitted malls and users within to return to pre-COVID normalcy. A few pointers on the strong consumption trends that we have witnessed. For the first 7 days of November, consumption across our mall portfolio was at 85% of consumption during the same period last year. In fact, our malls, Phoenix Market City at Pune, Bangalore and Mumbai, Kurla, are also witnessing strong broad-based growth over last year. Q3 consumption so far is already higher than Q2, where Q2 ended at 468 crore. As of November 11th, we have already exceeded this quantum, and we are seeing a current average run rate of about 8 crores of consumption each day across our malls. Even if we were to adjust for the festival base and average out October-November sales compared to last year, consumption level continues to show a strong trajectory at about 75% for the last year period across our major malls. Multiplexes are also now permitted to open across the country, and mall timings have been restored close to pre-COVID levels. F&B has been permitted to commence operations and operate in Maharashtra until 11:30. All of this has, in a manner of speaking, flipped a switch on consumption, and we've seen a strong growth since these formats have opened. We expect recovery in consumption to sustain in the coming few weeks as we move from Diwali to end of season sales and thereafter to Christmas and New Year celebrations. Footfalls are currently at about approximately 41% of last year's across our malls. If we were to compare to August 2020, when our malls recommenced trading after lockdown, footfalls have grown about 2.4 times across our major malls in the first week of November compared to the second week of August. We've seen an increase in four-wheeler and two-wheeler counts across our major malls. Four-wheelers and two-wheelers are at approximately 56% and 70% respectively compared to last year. And these have also grown in the range of 2.4 to 2.7 times compared to the second week of August. We have seen a broad-based recovery in consumption across categories in our major malls in the first week of November. Fashion and apparel specifically has made a very strong comeback in the festive season, with consumption levels in the range of 70% to 100% across malls compared to last year. Brands such as Lifestyle at High Street Phoenix have witnessed highest ever single day sales at any of their stores in India at our mall. We are very pleased to share that food and beverage, which commenced operations very recently, has seen consumption levels in the range of 55 to 70% in the first week of November compared to last year. Electronics continue to see a steady uptick with consumption at 84% across our major malls. Watches and jewelry have sustained their performance and are currently at about 100% of last year's sales. Hypermarkets as a segment is doing very well across our Market City malls in Mumbai and Pune, with consumption levels in the range of 100 to 150% compared to last year. With the easing of restrictions from lockdown, we are witnessing improvement in the hypermarket category as people are coming back to shopping at stores versus ordering online during the lockdown period when there was no such other alternative. Luxury brands such as Burberry, Dior, Montblanc are witnessing sales numbers well in excess of what they were reporting in pre-COVID times, as people are consolidating their spends on luxury, since there has been no spend in or limited spend in travel and holidays in this last 8 months. Specifically speaking about our Phoenix Market City at Pune, 65% of the stores trading there have exceeded 70% of last year's consumption levels. High Street, Phoenix Market City, Kurla, Mumbai, we are seeing this number at about 35 to 40% of the stores are at 70% of last year's, have exceeded 70% of last year's consumption levels. Our newest mall, which opened in Lucknow, the million square foot Phoenix Palacio, which commenced operations in July of 2020. In just 4 months of operations, this mall has seen trading densities close to 900 rupees per square foot per month and a trading occupancy of in excess of 60% of the stores. Since launch, there are currently about 136 brands that have opened their stores at Phoenix Palacio. We've signed 17 new brands in the July to October period, and there are 38 brands which are currently under fit out and should open up in the coming months. Our malls continue to remain the most sought after destination by retailers. Compared to pre-COVID levels, our vacancy levels have increased by only 1% during this period. Besides Phoenix Palacio, 14 brands have opened new stores across the rest of our mall portfolio in the last 3 months. And 14 more are scheduled to open their new stores in the coming months in our existing malls. To touch a little bit about retailer negotiations, we have broadly concluded the negotiations with most retailers and most brands within our malls. To get a little more specific, we had during our Q1 results and during our QYP discussions, we had shared the retailer rent negotiations were closed with 70%. We are now pleased to share that this number is at about 90%. We have concluded contracts with approximately 90% of our retailer partners. Any discounts that we may have given on minimum guarantee rent will be in effect only until end of March 2021, or consumption at those specific stores reaching 80% of the pre-COVID sales, whichever is earlier. This is also an understanding that we have with the multiplexes, which have been the last in all categories to commence operations November onwards. During this period of rent discounts, we are still recovering CAM expenses in full and also charging revenue share, which as part of our negotiations, we have increased by 150 to 200 bps higher than the contractual value. We have also, always maintained our relationship with our retailers and that we are partners in their businesses. So we have structured all these rebates, discounts to allow our retailer partners to get back on the feet. And we can see from their performance and, the clearing of outstandings that we have seen across all malls, that this has been very well appreciated by the retailers. We have also worked with them for us to have the ability to claw back some of these discounts and move closer to rentals or rental income closer to pre-COVID levels as business improves and consumption levels improve. So we have this higher revenue share percentage, which may extend even beyond FY21 for a short period of time before rev share comes back to contractual terms. As we stand today, our rents are scheduled to go back to contractual terms for all retailers from 1st April 2021, and this would include the multiplexes as well. We therefore expect to end FY21 with retail rentals at approximately 50% of FY20 rentals, based off the strong recovery in consumption in Q3 and Q4 of FY21. A quick update on our cash balance. We have focused our efforts on cash preservation and ended September 2020 with cash and equivalents of about 1,850 crore compared to 748 crore in June 2020. As you are well aware, in August 2020, we had raised funds through a QIP, and we received an overwhelming response from our investors. We were able to, net debt proceeds of about 1,080 crore in August 2020. The QIP proceeds have significantly boosted our liquidity position. As discussed during the QIP interactions, we view the QIP proceeds as a safety net in the short term, and as consumption at our malls improve and we see normalization of our business cash flows, we could consider using this liquidity as a war chest for potential acquisitions. I will now request Mr. Kanodia to update you on the financial performance as well as our debt and liquidity position. Thank you.
Hi. Thank you, Shishir, and greetings to everyone on the call. Let me share a quick update on our cash flows and the debt position, and also on the financial performance. We have conserved our cash through various cost rationalization measures, and we have managed all operational expenses and capex within the operational cash flows generated by various businesses during the first half of 2021. Our gross cash inflows during the first 6 months were 1,557 crores. Excluding the QIP proceeds, we had a net cash inflow of 457 crores for the first 6 months. Cash inflows for Q2 were significantly stronger at 342 crores compared to 135 crores of the Q1 numbers. We have also used some of our QIP proceeds to reduce our OD limits for a temporary parking of funds there. As a result, gross debt is down by 2,784 million rupees from rupees 47,489 million to 44,705 million. Our average cost of debt has come down further from 9.14% in Q1 to 8.88% as on Q2 end, representing a reduction of 26 basis points. Our lowest cost of borrowing across portfolio stands at 7.5%, and we are hopeful for further reduction in some of our other loans going forward. Nearly 2,000 crores of debt is coming up for repricing in Jan-Feb, and we are expecting significant savings to accrue to us on account of the banks passing on the interest rate reduction as the loans get repriced. On the credit ratings that we enjoy across our group, I'm happy to inform that no downgrades have been there over the last 6 months despite the challenging environment, and that speaks volumes of our cash flow and our business model. With the anticipated recovery in the retail rental malls and also various cost rationalization measures that we have taken, we expect retail mall cash flows to reach a level where they would start servicing their interest and principal obligations from no support required apart from the cash that they are generating from Q4 onwards. Moving very quickly to the financial updates for Q2 and for half year ended September. Our income from operations stood at 2,149 million for Q2, which is a 52% increase over the corresponding quarter last year. Our EBITDA stood at 917 million, which is 44% of the corresponding quarter of last year. This quarter, we reported a loss of 359 million after accounting for minority interest. For the half year ended September, income from operation was at 3,496 million, EBITDA at 1,619 million, and we reported a loss of 783 million for the 6 months. We continue to remain prudent in our cash flow outlays and engage on a regular basis with our various stakeholders to see through these challenging times. With this, we would close our opening remarks, and any specific questions that you may have, we would be happy to take those now. Thank you.
Thank Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. In order to ensure the management is able to address all the questions in queue, we would request you to please limit your questions to 2 per participant. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, hi. Good morning and congratulations for coming back strongly into this quarter. Will it be possible to share the cash flow breakup of what kind of cash flows you receive from mall, commercial office, hotel, resi, and the other operational expenses and capex?
Sure. This is for, are you asking for the
Q2? Q2, yes.
Q2 specifically? Okay, Puneet.
Yeah.
Hi. Happy Dhanteras.
Yeah,
yes, commercial office business, we saw about a 77 crore cash flow.
Okay.
Residential was quite strong in this quarter, and in fact, Q3 has been very good for us, but residential was about 64 crore.
Okay.
The St. Regis Hotel was about 28.
Okay.
Retail was about 160. And over and above that, we had an IT refund of about 60 crore, and we had a settlement with one of our old partners on one account was about 28 crore.
Okay.
Over and above this, our subsidiary, Market City Resources, which provides mall management services to all malls and including the JV that we have with CPPIB, there was about 22 crore. I think this is for the half year.
Okay, the entire number is, okay, all is for half year, okay.
Yeah, these numbers are for half year.
Okay. So 22 crores. And capital expenditures?
Capex during this period for the half year was about 137 crores. We had estimated we had revised our Capex projections for FY21 sometime in June, July this year, where we had estimated that we would spend about 330 crore during FY21. We have spent in H1, we've spent about 137. We expect to spend another 85 crore each quarter for the next 2 quarters. Yeah, Q3 and Q4. So we'll be in that range of about 310 to 320 crore capex.
Okay. Got it. Secondly, the receivables also seems to have gone up a bit in the first half. Can you give more color on that? Is it with respect to the deferment or is there more to it?
Yes, it's actually a combination of deferment and also that, now that we have we've concluded our negotiations with 90% of the retailers and documented the same. We are expecting in Q3, we've started seeing a lot of the old dues come through.
Okay.
So, yes. So Q2, the receivables went up, but it should start normalizing in Q3, Q4.
And have you concluded the agreements with the multiplexes also in this 90%?
Yes, we have.
Okay. And can you give some color of what?
Across.
Yeah. Can you give some color on what kind of contracts there?
Correct. So generally, our multiplex rev share is in the range of 17 to 18%.
Okay.
From the time the multiplexes were allowed to operate in the respective states,
yeah,
for until the period of October, November, December, for these 3 months, we have given a waiver of about 75% on the fixed rental.
Okay.
So, and in the last quarter, Q4, the waiver comes down to 50% on the fixed rental. Revenue share has moved up from 17 to about 22% for this period.
Okay.
Q3 and Q4.
Okay.
So waiver on MG for Q3 is 75%, Q4 is 50%, increased rev share for that period, and from Q1FY22 we move back to contractual terms, including any escalations that would have kicked in during this period.
And would you move back to 17% rev share, or will the 22% remain?
Yes, I'm just coming to that.
Yeah.
So we move back to 17% of rev share for Q1 alone.
Okay.
And then Q2FY22 for a period of 1 year, starting Q2 for a period of 1 year, the rev share moves up again in the range of about 20%.
Okay.
So that's a little bit of a catch-up that we are looking at as a catch-up potential as part of our negotiations. So you move back to contractual minimum guarantee rent, but rev share moves up to about 20% for a period of 1 year from Q2.
Okay. And this kind of escalated rev share which you talked about, 150 basis points, will that be applicable for FY22 as well for others?
So it's there in some, it's not there in some. So it may be there only for a limited period in I would say 60% of the cases, and for about 40% we will have that catch up available. 40 to 50% we'll have the catch up available.
Okay, great. That's all from my side. Thank you so much. Happy Diwali to all of you.
Thank you.
Thank you. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, good afternoon, everyone. Just quickly on the cash flows which you just shared a while back, those you said was for H1 or Q2? The malls at 116 crore collection, was it for H1 or Q2?
This is for H1.
H1, okay. That seems a little on the lower side considering 50%. We are charging 50% to our tenants. So how much of
So like as
will be the receivables here? Yeah.
As I mentioned, there is a little bit of backlog in the collections because we were in the middle of the negotiations until the end of September. And multiplexes, etc., for example, we've only been able to conclude about 2 weeks ago. So there is a backlog of collections, but in Q3, starting October, we have started seeing an increase in the collections. I would say that in terms of invoicing versus collections starting Q3, we are very close to being current. And so that includes some of the backlog also coming in.
That's helpful. Also,
so just to give you a little more clarity, like Q1, our overall collections across the businesses was about 135 crore. Q2, it's moved up to 342 crore.
But there are a bit of one-offs, right, in terms of IT refund and the settlement with your old partner of close to almost 90 crores amounting to that. But yeah, excluding that, it's still a jump up versus Q1.
Actually, if I remember correctly, the IT settlement and the refund that came in Q1, not in Q2. So the one-off was in Q1 formed part of the 135 crore.
Okay, great. Thanks for clarifying. Also, in terms of, since we must have started paying interest, how are we in terms of interest servicing? Are we able to service it adequately, or there's still some cash burn after paying interest?
Sorry, may I just clarify? Out of this 60 plus 28 crore, 60 crore of IT refund, Q1 was 40, Q2 was about 20 crore, and the settlement from one of our existing previous partners of 28 crore, that also came in Q2. So 48 crore was in Q2 and 40 crore was in Q1.
Okay.
Yeah.
Kind of split evenly.
Yeah. So that 48 crore in Q2 forms part of the 342.
Sure.
Yeah, roughly 100 crores of operational cash flows moved up to about 300 crores in Q2. 100 crores in Q1 moved up to about 300 crores.
Yeah, sure. I just want to understand, since we started paying off interest from this quarter on, from September onwards, how are we looking at the cash flows? Like, last quarter we had a cash burn of 65 crores. How has been the cash flows been, like overall cash flows been this quarter?
I'm going to request PK to answer this. I think, Pradyumna, may I request you to take this one?
So just to give a sense, approximately our payouts towards the bankers, both interest and principal going forward for the next 6 months is approximately 80 odd crores per month. And given the fact that we just spoke that our rental collections are now getting back to normalcy, our cash flows from Resi is becoming stronger. We have not seen a burnout. We don't anticipate a significant burnout from our existing cash flow positions to meet any of these obligations. Even if we look at Q1 to Q2, the reduction in the funds available was marginal from that point of view. It was not very significant. But given the fact that collections are really getting back to normal in the period of October, November, and going forward now with the F&B and multiplexes beginning to also be part of our operating numbers, we don't anticipate any significant burnout in terms of our existing cash that is available. And this 80 crores a month would be almost, I would say, maybe in October there would be a marginal requirement of support, but otherwise going forward from December onwards, we don't anticipate any shortfall across any of our projects.
PK, would it be correct to mention that in Q1 we saw an operational cash burn, whereas in Q2 we had almost 100 crores of surplus, operational cash surplus. And Q1 was about a cash burn of about 65 crores.
Correct. So that is because we didn't have any interest and principal to be paid out in the first 2 quarters. But from a interest and principal payout, we are hoping that there will be no burnout starting from November end.
Okay. And my last question is to Shishir. You mentioned in your comments that you go back to your original agreements once tenants achieve 80% of consumption. Last quarter, this number was around 70% of consumption. So just trying to understand, like, is it something like a flexible target?
No, it's not a flexible target. It varies from contract to contract, negotiation to negotiation. So, and given that the mall opening in Maharashtra was delayed, and it actually commenced operations only in August, I think in some of the cases we've had to negotiate a 80% threshold before we move back to contractual rent for that month.
Mm-hmm.
Chennai commenced operations only in September, and mall timings were restricted. So we did face some issues in the negotiation on this front, but it was around 70 to 75% was our estimate. And I would say that now in some contracts it's still at 75%, 70%. In many of them it's moved to 80%. But we're very close to breaching that threshold across the board now. For November, for sure, we should be able to get contractual rent on many of our stores that are operational.
But is that like once they cross, then the agreements move to the 100% fixed contract or fixed rental?
No, it doesn't move to 100% fixed contract. It moves for that particular month in which the consumption has been achieved. Okay. Compared to previous year same month. So for that month you move to contractual rent, and in any case it is only applicable from now until 31st March, because from 1st April we are back to contractual rent, MG at least.
Yeah, got it. Thanks so much, and very happy Diwali to all you guys.
To you too. Thank you.
Thank you. The next question is from the line of Biplab Dev Burma from Antique Stock Broking. Please go ahead.
Hi everyone. Happy Dhantara. So my question is on your this thing on average consumption. You mentioned that it is around 50-60% year on year, and in some category I understand that the consumption would be 90% or more than 100% year on year. So that means that in some other category it would be something around say 30-40%. So in such cases, quite possible that these vanilla tenants might be making losses or burning cash. So, sir, did you witness any tenants leaving or coming back again for negotiation?
Not really. I think, as I mentioned, we've concluded the negotiation in excess of 80% of our tenants, which includes multiplexes. Yes, there is some pressure on the F&B tenants, which is quite anticipated. But generally, I would say that our vacancy has really not increased from December last year until now. Our vacancy level may have increased by 1%. And these would be on account of smaller, localized formats exiting who didn't have the ability or the cash to sustain through the COVID period.
So, sir, so what about those who are doing? Is there, is there cases where tenants are doing, say, 30-40% of the business they are doing previous year?
There may be very few cases of that but I don't think the number of tenants who are in that range is very, very high.
Oh.
Very, very few tenants who would probably be in that category.
Okay, sir. That's good. Just this is I know this is very unlikely, but still, is there any new leasing in any of the malls post-COVID? I mean, and in this new leasing, is the contract similar as the existing contract? I mean, you have a new mall and there might be a new player who wants to replace, trying to occupy space. Is there any such cases?
Yes. So we opened our new mall in Lucknow, Phoenix Palacio. We've signed, since July, we've signed about 20 new brands at that one location. At our other locations, we have about 30, I would say 14, 15 new brands that have come, and 17, 18 other brands are under fit-outs. These are contracts that we may have executed just prior to lockdown, who have gone back into the mall and started doing their fit-outs. Under Armour, for example, opened their new store at High Street, Phoenix. So they opened sometime in August end, and that was a new format that came in, and they are now expanding across all our other malls as well. I would say that even the new leasing that we've done in Phoenix Palacio, Lucknow, we've executed contractual terms which were as per our business plan estimates even prior to COVID. So there's not been any deviation. So we may have given them some limited support. So even if it's a new lease, the agreement will, let's say 150 rupees per square foot, for example, but we may have given them that discount on fixed rental until 31st March, after which they move to that 150 rupees kind of a structure. So in fact, in the last few days, we've seen that Lucknow Mall has crossed a trading density of 1,000 rupees a square foot. And it's already about 85-90% leased.
Sir, if I may squeeze me one more question. So multiplexes have started, and in some cases they're expected to start, and in some cases they have started. In some malls they have started. So just wanted to know, because multiplex is an important anchor for a mall. So when do you expect multiplex business to gain traction? Because that would also enable incremental footfalls in your mall. So any insight on that? When do you expect the multiplex business to gain traction? I mean, do they have enough inventory when they are going to release new movies? You might have had that kind of.
I think that the issue here, Viplav, is about two things. It's about content and the government restrictions. Since the multiplexes have commenced operations, we are not seeing consumer demand being very, very high as of now. But as new content comes out, we expect to see, crowds coming in. So it's difficult to gauge by when that is likely to happen. But this is the festive season when I think it should pick up in the next month or two. Our PVR, our multiplex partner at most locations, they are very, very positive on the demand picking up as the government restrictions ease out a little bit and more content becomes available.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. We would request the participants to please limit their questions to 2 per participant. The next question is from the line of Saurav Taparia from UBS. Please go ahead.
Hello. Hi guys. Quick question here. So can you help us understand the movement in base retail rent income for the quarter? Given improvement in business quarter and quarter, base rent recognition should have improved, right? And that's my first question.
Sorry, I didn't quite catch your question. When you say base rent, are you referring to the minimum guaranteed rent?
No, I'm referring to the base rent income for each of the malls that we report, right?
Yes. Okay.
So that base rent income has declined for the quarter versus previous quarter on an aggregate basis.
Understood. When you say base rent income, you're talking about versus projections, or you're comparing it Q2 to Q1?
Q2 to Q1.
Okay, so let me explain this to you. We have given some additional support in this quarter. So, for example, in the last quarter, while we had our discussions ongoing, we had raised some invoices, etc. And as we've concluded the negotiations, we have probably given some credit for the previous period and adjusted that. So that could be the only reason for that.
Sure. And okay, my second question would be, when you say business for the weekends or say for the first week of November has improved to 85%, how are footfalls panning out there? And more generally, do you expect the current levels of footfall to be enough for us to reach 85-90% business in Q3, Q4?
I'm sorry, Saurabh. I will have to request you to repeat your question.
Okay. So when you say in first week of November, we are at 85% versus last year. What has been the footfalls? Has it improved versus 41%?
Footfalls are close to about 50% of last year.
Okay. That's it. Thank you, and I'll come back in queue for further questions.
Thank you. The next question is from the line of Atul Mehta from Motilal Oswal. Please go ahead.
Hi. Good afternoon and happy Dhanteras and Diwali to everyone. So just a couple of questions. One is on deleveraging. So any progress that we have made so far, and anything that we're likely to conclude soon on the deleveraging side, and maybe another platform deal like on the lines of CPPIB and so on. So any progress on that count?
Nothing as of now to talk about, but there are active. I would say there are ongoing discussions around, let's say, an acquisition structure or in some form. But I would say that there is nothing material to share with you at this point in time.
Right. And so anything on the similar count, any timeline we have in terms of thought process on when likely we would want to be, say, either debt-free or we would want to conclude a platform structure and so on. Any timelines to that?
See, these have been very uncertain times, and while for us, clearly our goal is to be, to reduce our net debt levels, right? So, and that this is an ongoing, I would say over the years we have actively worked towards this. Platform creations are certainly going to help reduce your net debt levels. But these are, longer term partnerships. One can't rush into it, and you don't want to rush into something like this when there is uncertainty in your business and valuations are usually suppressed. So I would say that if there were to be any serious conversations on this and interest even from our side in pursuing this, we will have to wait to see this, how Q3 and Q4 pan out before we take any active decision on that.
Got it. And secondly, on the other side of the spectrum, in terms of M&A and opportunities in M&A, how do you think about it? How do you balance it? Like, on one end, like you said, it is suppressed valuations to get into a platform deal, but on the other end, those same suppressed valuations could be an opportunity on the M&A side.
Absolutely.
So how do you look at M&A in that sense? Yeah.
So there again, as we explained, we have about 1,850 crore of cash and equivalents available with us, which we have, kept aside as a safety net for the moment. We had always anticipated that by November, December, and Jan, we will start seeing operational cash flows start, reaching normal levels or pre-COVID levels. And that's when we would start looking at acquisition opportunities. I would say that there are quite a few out in the market. Very few of them are quite interesting as well. And we continue to evaluate these opportunities so that when the time is right in 2 months, 3 months, we can start considering which one of these we want to exploit and deploy capital towards.
Thank you. We would request the current participants to please come back in the question queue for any follow-up questions. Due to time constraints, we would request the participants to please limit your questions to 2 per participant. The next question is from the line of Chanchal Khandelwal from Aditya Birla Mutual Fund. Please go ahead.
Hi team, thank you for the opportunity. Few of my questions have been answered, but something on the wanted to pick the brain of the team on what did you learn from this crisis? I mean, I have seen your app. You have tried to do something on the Omni channel, but I don't know how successful that has been. Your debt was high going into the crisis. You have deleveraged your balance sheet. You're more under construction. 4 of them are there. But anything you want to just highlight which you could have done better, which will play out to get incremental footfall going forward when the malls are opened?
Yes, I think one learning, or rather one realization for us was we were working on a digital integration of our physical malls and being able to connect with our mall customers even outside the physical confines of the mall. So this was a digital initiative that we had undertaken just prior to pre-COVID levels. We had run a pilot on one of the modules of the project at Chennai, and it was starting to see success before we went into lockdown. So clearly that is something that we have expedited, and we would be probably, I would say, 4 to 5 weeks away from launching a Phoenix, digital platform called Phoenix Enhance, which will be available as a web app and also as a downloadable app. This is going to combine customer services and customer convenience along with a very, very fulfilling and enriching rewards program. So I think I would like to announce this in about 4 to 6 weeks, the launch. And initially it's going to be run across Phoenix market cities in Bangalore, Chennai and Palladium, Mumbai. before we roll it out to other locations. I think this is going to be a very engaging and a very enriching platform for our customers as well.
Interesting. I hear you. So this is one new thing which you're talking about, the app. So which looks very interesting from the point that so a brand like Zara or Hamleys or who are not available across the board in online space, will they be interested to partner with you in this Phoenix app which you're talking about? And now that you are there in Lucknow, Indore, and multiple more cities, it can help you ramp up at least in top 10 cities, if not more.
Clearly, an extension module of this app, which we are expecting to go live, let's say in about 9 months from now, is the online sales of our brands across this platform. And clearly, there is a lot of interest with our retailer partners who are very excited to see an additional channel for their sales, and which will be powered and backed by a very strong rewards program. So yes, there is a lot of interest in participating on an omni-channel sales platform as well. But that's a module that will get integrated into this Phoenix app in about 9 months or so.
Thank you. We would request the current participant to please come back in the question queue for any follow-up questions. The next question is from the line of Swagato Ghosh from Franklin Templeton. Please go ahead.
Yeah, thanks for taking my question. 2 questions. First is, we have obviously done very well in navigating through the crisis, but do we plan to go one step further and maybe actively churning our clients and maybe weed out tenants who are probably not seeing much traction, or would it be business as usual and we wait for recovery? So how do we plan to approach the next few months?
I'm sorry, can you break that down a little more for me so I understand the question properly?
Yeah. So just to clarify, just in case recovery is not very fast and the pain is prolonged, can we do some active asset management in terms of churning out the slower tenants, bringing in more of the segments which are probably recovering faster? Can we think on those lines?
Absolutely. I mean, this is an ongoing part of our business, whether impacted due to COVID or not. This is an important aspect of our business, and we continue to evaluate, which are the non-performing stores and how we can replace them with other brands that are more aspirational or will see more volumes.
Okay, but have we done anything on those lines in the last 2 quarters?
See, in the last 2 quarters, it was not practical to get into that. But currently, we are seeing, yes, we have been engaged with a few new brands to come and take up some spaces, which is going to come out in churn.
Okay. And that's helpful. And second question is slightly longer term. How do you see Phoenix as a company in terms of the mix between retail and office space? And the related question is, can we do a project where you do 100% office? I'm talking about a new project in the future, because mostly our current office projects are part of retail projects, sort of a mixed use. But going forward, can we see that sort of development as well? And longer term, what should be our mix between retail and office? Longer term as in 5-6 years.
So at the moment, we do not have any aspirations or plan to become a pure office development company. For us, our focus remains retail, city center locations, and where we will, after planning out the retail to its best potential, we will consider utilizing the balance FSI potential on that land to build out other asset classes on top of the malls generally. So we are not deviating from this focus. As we speak, we have under development several malls. We expect by FY24 we will have almost 12 million square feet of mall space operational. Simultaneously, we'll also have about 5.5 million square feet of offices which will be operational forming part of these mixed-use developments. And I don't expect us to go into the office development space if not part of a retail development.
Thank you. The next question is from the line of Abhishek Bhandari from Macquarie. Please go ahead.
Hi, Shishir. I just had, one question. If you could give some update on the commercial project and the, high retail, what you're planning at HSP as a part of the vacant land what we have. And a related question is that, of late, what we have been picking up is that the interest from developers to suddenly, invest a lot of money in offices again picked up, specifically in Mumbai, where, some of the South Indian companies are also talking about large-scale developments in Worli, Mahalakshmi area. So, if you could share your thoughts, do we see the demand to be so strong in the current, and given the current infrastructure constraints that, it makes sense for us also? Thanks.
Correct. So we will, Abhishek, we will be happy to share with you how the infrastructure coming up and around Lower Parel is going to decongest that area and more specifically our site, and how we have our plans of creating a very, very good access to our Lower Parel location development without having to come onto Senapati Bapat Marg at all. So from Worli Naka, there's a separate turn and a DC road which connects to our site. So we will be happy to explain that to you. I think there are a lot of infrastructure projects underway which are going to create which are going to help decongest that entire area. Having said that, is demand very high in that part of the city? No. At present, demand does seem to be taking a bit of a hit, but supply is low. So while we also hear about large scale projects coming up in that general area, currently when we look at the potential supply, it's very, very low. We believe that our development at the expansion project at Lower Parel, which we call Project Rise, we believe Project Rise is very unique in terms of its location, access, being part of this larger, vibrant, high energy development. And it will become, as a product, it will be a far superior product compared to the existing supply that is there and anything that is likely to come up. We are very, very excited with this project, and we will hopefully be able to share some more details in our next quarter on the project and the design, etc.
Okay, thank you and all the best, and wish you very happy Diwali.
You too, Abhishek. Thank you so much.
Thank you. The next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hey, hi, Shishir and team. Two questions. Firstly, on slide 9, we see this gap between the permissible area operational and the actual area operational. Is it just malls? Is it just multiplexes? And are we getting paid for 100% of it, or the part which is just open? So that's first question. And the second question is, when you're talking about M&A or new sites, which cities are on your mind now? Thank you.
So I'll answer your first question. The gap between the permissible area and permissible operational area is basically FEC, multiplex, and some F&B. Since this is as of end of September, we didn't have F&B also operational at several locations, right? It was not permitted in Maharashtra. End of September, several F&B brands were not allowed to operate. So if you actually look at October, November, you will see that the permissible area operational is about 91% and 91.5%. And multiplexes will commence operations in actually, yes, this week we will see Kurla also operational, the multiplex operational. Chennai is not yet allowed to operate.
Okay, so this number will be 100%, right? The area operational to permissible ratio. This should be 100% by December, yeah?
Yes, it's only the FECs, which will then, that could be a slight gap.
Right. And the second question, Shishir. M&A.
Sorry, what was your second question on M&A? If there are deals under...
Which cities are you looking at now?
No, our mandate list of cities remains the same, as there's no change to that in this environment. So we continue to focus on tier 1 opportunities. We would be looking at let's say another location in Chennai, Hyderabad, Chandigarh, Calcutta. Calcutta, we've already announced that we have a acquisition underway, and I would say perhaps something in the MMR region as well, Gurgaon. So these continue to remain the cities of our interest.
Okay, thank you.
Thank you.
Thank you. The next question is from the line of Adhidev Chattopadhyay from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. Do you have some sense of the Indore mall, when do we expect to start, and for other Pune, Bangalore and Ahmedabad? So any revised timeline, or when do you think they will be operational?
So we have, we've recommenced work at all sites. In fact, we look at the project at Hebbal in Bangalore. We've seen a very good ramp up in manpower. Wakad, Pune is still seeing some shortage of manpower. We expect to make Indore operational by end of FY22. Ahmedabad should be operational first half of FY23. And Hebbal and Wakad by end of FY23, early FY24. These are our completion estimates.
Okay, that's it from my side. And all the best and happy Diwali.
Thank you.
Thank you. The next question is from the line of Girish Chaudhary from Spark Capital. Please go ahead.
Hi. Thanks for taking my question. Firstly, just a follow-up on the previous question. If you can just also help us on the pending capex for the second half of FY21, 22, and 23 also for the upcoming malls.
Sorry, capex on the upcoming malls?
Yeah. The pending capex which needs to be spent.
Correct.
For these malls.
On the upcoming malls, we have roughly around 1,500 crore balance to spend from now. And in this year, I would say in FY20, as we had mentioned, in the second quarter of FY21, we expect to spend about 180 crore more. FY22, FY23, each year we should, see approximately 550 to 600 crore of spend. And, there's also a retention amount which gets paid out only after the completion, which we expect to pay out in FY24.
Okay.
If I may just mention that across all of these locations, the malls that are under development, we don't have any debt on these assets. And over and above this, we also have the office expansion, which will also continue, and the capex on that we will update on this perhaps in the next quarter.
Great. And the second question is on the residential business, which has seen a good traction relatively. So I know there has been some rejig in the layout, etc. But has there been any change in the pricing per square feet there?
No, there has been no material change in the pricing. We have, in fact, I think the demand is fueled by a couple of things. One is the interest rates coming down. The other one is the stamp duty getting reduced. And thirdly, this product is a far superior product. So from July until November, we sold some 18 units at an average price of 15,000 rupees a square foot plus. And So that would translate to about 107, 110 crore of value that we've done at this price.
Yeah. Got it. And then just the last one on the you have close to recognized around 1,600 crores for this business. So just wanted some data on the pending collections and the pending construction cost for this business.
On the residential?
Yeah.
Sorry, I didn't understand the question. May I request you to repeat?
So you have recognized cumulatively close to 1,600 crores of revenues.
Correct.
So how much is pending from a collection point of view, and how much is the pending construction cost for the project to get complete?
Okay, so we are currently building out Tower 7 in One Bangalore West. And towers 1, 2 through 6 are complete. Kesaku is complete, so there's no construction cost to be incurred there. We have Tower 7, which is under construction, will require another 50 crore to complete. And, this is getting funded by the sale of the units themselves.
Thank you.
So we have 1,600, sorry.
Sure.
I'd like
Go
to
ahead,
finish
please.
this. We have about 1,600 crore of completed inventory, against which there is no construction cost. Every sale that we do, there's no cost to incur there. And 50 crore towards Tower 7. Towers 8 and 9 we've not yet launched.
Thank you. Due to time constraints, we take the last question as Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. So, sir, firstly, in the last con call, you had highlighted that for operating period, the rentals are expected to come in on monthly basis, but for the lockdown period, it has been deferred over a period of time. So, in that context, can you help us understand what would be the mix of operational and lockdown period rentals in the current quarter, and by when do you expect to receive the rentals for the lockdown period across retail partners?
Yes, I think this is a question we'll take on offline, and I'm going to request you to connect with Varun to get this breakup. I do not have this available at this point in time. Few pointers for you. This deferment we had offered only to the anchors for the moment and large group brands generally across the country. As I mentioned, there was some backlog. So collections for it would be I would say a more detailed information or more clarity if we take a look at October, November collections as well, because that will clear out several of the backlog. So may I request you to connect with Varun and get this information in a more granular form from him?
Sure, sir. That's helpful. And sir, on commercial, so there has been some moderation in commercial revenue on sequential basis. Can you help us understand the same? And also, if you could help us, how has been the leasing momentum or pre-commitment at recently completed Fountainhead Tower 2 and Tower 3?
Fountainhead Tower 2 is now complete. We've received the OC there. Tower 3 is still awaited. We are I would say that the tenant interest in that product, it's a non-IT building. So tenant interest in the product for that 12,000 to 20,000 kind of size offices remains to be moderate. I would not put it at very high. We have some inquiries that are ongoing, and we expect to conclude 2 or 3 transactions, which would lease out about 2 floors of Tower 2. We had some vacancies during quarter 2 in Art Guild House, but this was all. I don't believe anything was out of contract. It was just no extension of an existing contract.
Sure, sir. That's helpful. Thank you, and all the very best.
Thank you very much.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Shishir Srivastava for closing comments.
Thank you very much for taking the time out to join us today. And we wish you a very, very happy Dhanteras and a very happy Diwali and a happy New Year going ahead. Hopefully this festive season will bring a lot of cheer to all our lives. And we look forward to connecting with you during this period before the end of the next quarter and at the next quarter call. Thank you so much.
Thank you. On behalf of Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.